Good afternoon, ladies and gentlemen. It's always a pleasure to come back to Dublin. That's why I'm particularly grateful to ICMA, not only for giving me the opportunity to address this broad and distinguished audience, but also for being able to do this here in Dublin. As it was said, this is my first official speech as Director for Financial Markets. Previously, I was Director responsible for other areas like audit, accounting, credit rating agencies. But this first occasion is for me very important because I will be able to speak about one of the most prominent files that I have in my portfolio, which is, by the way, also one of the top priorities of the Juncker's Commission, which is the Capital Markets Union project. And to tell you where we are, let me start briefly by the beginning. In the last years, during the financial crisis, the main objective of the Commission action in this area was basically to restore financial stability. So trying to address all the market failures, market vulnerabilities, which emerged one after the other, and that we have tried to address with no less than 40 new legislative initiatives which have been proposed, agreed, and to a certain extent implemented in the last 7 years. Today, the focus has switched. I don't want to enter the debate on whether the financial crisis is over or not, but in any event, what we need today is more investment. We need it. We need it if we want to pursue the objectives of the Juncker Commission, which are jobs and growth, ultimately in view of promoting prosperity of the EU citizens and beyond. EU is starting to grow again, but not fast enough. 23 million people are unemployed. 1 out of 5 is under 25. We have an aging population with increasingly fewer people to support it. So we need to reflect seriously in this context to the functioning of capital markets in Europe. And we believe that capital markets should be mobilized in order to channel resources to companies, notably, but not only, to SMEs and to infrastructure projects that needed to expand and to create jobs. In the past, capital markets have been criticized for not serving the purpose that they had been created for losing sight of the end users that were supposed to serve. Now, going forward, we need capital markets to better fund the real economy. We need capital to fuel productive investment and to allocate risks to those parties which are most able to deal with those risks. It's on that basis that in September 2015, the Commission adopted an action plan on building a capital markets union that seeks, in a nutshell, to develop, to encourage market-based finance. It's a broad, structured program with, at the moment, no fewer than 33 measures, and that we undertook to deliver by 2019. And as it was said by us from May 1st, 2016, I've been asked to take this under my responsibility and to make it happen. At the end of April, a first status report was published, and it's publicly available. It shows that we've done a little bit of progress, well, some progress, some meaningful progress, but it also shows that we need more in order to deliver. So let me recall what are the objectives. the 6 main objectives of this plan and what are the actions that we've taken already and that we plan to take within these objectives. Our first objective is to provide alternative sources of funding for startups and non-listed firms. It was discussed. Maybe we have an internal market for big listed firms, but we don't have it for small startups and non-listed. A small population, only 1.5% of high-growth companies account for more than 30% of new jobs. So developing an alternative funding tools for SMEs, especially in their expansion phase, is of utmost importance to put the economy back on track. On that aspect, the CMU Action Plan places great emphasis on strengthening our European venture capital markets. In this area, we're still lagging behind the US, for example, where venture capital represents 8% of outstanding financing to SMEs, while here in Europe, the share is only 1%. Even more telling is that around 90% of the EU venture capital investment is concentrated in 8 member states only. So there is scope for improvement, for widening these instruments. So we're working concretely on 3 specific measures to scale up the supply of venture capital, imminent measures. By summer, we will propose a new framework for the EU venture capital, which exists already, but we will make sure that larger managers will be able to run venture capital funds, and we will widen also the category of the eligible investment opportunities in order to qualify for the EU label, let's put it like this. Secondly, we will also launch a brand new pan-European venture capital fund of funds. Contributions will come, of course, from ourselves, from the ESIF fund, but also very important will be the contribution of the private sector. Very soon we will publish a call for expression of interest, inviting private sector asset managers to apply for operating this fund. Third, in January, we launched already a study looking at tax incentives. So looking at studying the way different tax incentives in different member states for venture capital and business angels, how they prop up investments into startups. So the idea here is to promote exchange of best practices towards the end of this year. We will see how to best do it, but that's the idea. Now, moving up to the funding escalator, we are also working on another alternative source of funding for companies. And I know that you're very interested in this because it's private placements. Market forces, ICMA in particular, are already pushing in the right direction, and we are fully supportive to your private placement guide. It has certainly contributed to the robust, meaningful growth of the pan-European private placement market, which doubled in size in the recent years. But still, we believe that it remains largely underdeveloped, especially in some member states, and we would like to understand why. So we are launching field work on the ground, in order to identify the remaining regulatory barriers or barriers of whatever nature which basically constitute an obstacle to the development of the private placement market. Second objective is to make it easier for companies to raise funds on public markets. This is a challenge on one end, but also a vast source of potential funding. US public equity markets are twice the size of the European ones, so there is, here again, room for improvement. If we want to make listing and public offer a viable funding option, we need to reduce the price of the entry ticket. The compliance and legal costs associated with the public offer, and notably linked to the prospectus, can absorb up to 8% of the capital raised through a small issuance. This is clearly a showstopper. And therefore, we've already acted, and it's one of the first measures that we took. We proposed amendments to the prospectus directive in order to streamline it, in order to simplify it, in order to introduce proportionality, in order to make it easier to issue the prospectus, but at the same time trying to preserve the same level of high investor protection. This proposal is going through the legislative phase. It's going pretty smoothly. The member states, so the Council and the Parliament, are working very hard, and I'm optimistic that pretty soon we will see the end of the tunnel. For larger firms, corporate bonds are a valuable mechanism for raising debt finance on a larger scale, of course. Favored by historically low interest rates, issuance of euro-denominated corporate bonds now has more than doubled since 2008. In recent weeks, as you know, some businesses have been issuing at negative rates. Still, despite this record primary issuance, market participants, including ICMA members, have raised concern about the liquidity of the secondary market. It has been discussed already. We all know that if credit conditions were to deteriorate, some firms may quickly find it hard, if not impossible, to access debt markets. But this is a very complex issue, a political issue, I would say. To get a better picture of the whole situation, we started a comprehensive review of the functioning of corporate bond markets in the different member states. So the review looks at possible ways to widen access to and deepen liquidity in light of changes observed in the recent years affecting market structure, behavior, issuance, liquidity. So on March 18, we published a tender for a study on the drivers of corporate bond market liquidity. And we will pretty soon also publish a call for application to establish an expert group which will be specifically in charge of looking at these issues in detail. Third objective, promote investment in long-term sustainable projects and infrastructure. I don't need to tell you how important, and I don't need to describe the potential of the infrastructure market in Europe. It's enormous. At the moment, all what we see is that less than 0.5% of the, for example, 10 trillion euros that insurance companies have available to invest, only 0.5% goes into infrastructure investment. As you know, we've already acted in that area already. We've modified the Solvency II regime in order to reduce capital charges for those insurers who decide to invest in qualifying infrastructure. This is done already. We only hope that the insurers will make the best of it, and soon. Green and sustainable finance, also very high on the agenda. The Commission is very supportive of every market-led initiative, like, for example, the ICMA's green bond principles, which we welcome very much. So we are strongly behind. I see the time is running, so I'll try to be short on the last points. Fourth objective is to offer broader and better investment opportunities for retail and institutional investors. We all know that households are the main providers of funding. We all know that today they are less involved in capital markets than in the past. They tend to keep significant savings in bank accounts or deposit, and they do not invest them for future retirement or for their life goals. In some member states, just to tell you, in some member states, financial assets kept in the form of currency or deposit represent as much as 150% of the GDP. So a big challenge for us is to try to ensure that retail investors can again participate actively and efficiently in capital market investments. We are working on that. One specific action in this respect relates to private pension provisions. At present, as you know very well, there's no effective single market for so-called third pillar personal pensions. By end 2016, we will assess the case for a policy framework to be established at European level on that. We will start with a public consultation, a study, which is of course what the better regulation principle imposes, and we will see whether a legal framework will be needed. So again, be careful and be attentive to that area. For institutional investors, I've already mentioned the action recently taken in order to make sure the insurers invest in infrastructure, but we are ready to go even a little bit further. We are even ready to assess whether changes are needed to the prudential treatment of insurers when they invest in private equity and private placements. However, for everything or for such an important reflection like that, we need strong evidence. So again, we rely on your support. We need to understand whether those products offer sufficient transparency and credit quality to justify a more risk-sensitive prudential treatment. Fifth objective, very briefly, leverage bank capacity to support the EU economy. Bank lending is and will remain a very important source, of course. I mean, capital market union is not about discouraging bank lending, or it's about promoting alternative sources, but I mean in a complementary manner with respect to banks. I mean, the proposal on securitization, which has been mentioned by Stephen and Robert before, is precisely has been precisely adopted with this idea of basically free up or increase quality of bank lending. Our proposal, I mean, is probably not necessary to recall it, but basically sets out the criteria for the simple, transparent, and standardized securitization, and as a consequence, reduced bank capital requirements for those who qualify. The proposal, as Stephen said, is now has been adopted and agreed in record time by the member states, really quickly. Now it's up to the Parliament to react. I hear that they will vote in November. And basically, from my personal feeling, is that there will be no major stumbling blocks. Of course, the Parliament will ask for some amendments, and this is normal, but I think that in essence, the objective of the proposal will be respected, and again, the earlier the better. Finally, our sixth objective, tear down unjustified barriers to cross-border investment within the EU. We've set up a group of a representative of each member state in charge of identifying the remaining barriers in their territory. The outcome of this exercise will be known at some point in autumn. Also, for example, another example in that area, we are going to launch another targeted public consultation on the distribution of funds, UCITS and AFMD. We hear and we know that there are problems related to the cross-border distribution of funds. We want to have figures. We want to know exactly what they are. We know that they relate to fees, notification procedures, various administrative burdens, registration, different treatment in different member states. We want to have figures. We want to know exactly where they exist, and we want to see exactly what needs to be done. I'll conclude. I would like to recall you that CMU is a pro-business, pro-investor, pro-growth agenda. I'm well aware that implementing this action plan is going to be difficult. The environment is moving. We will have to overcome the challenges of selling capital markets in a period of volatility. I'm also aware that it's not going to happen overnight. It's a long-term structural project. But to achieve its full potential, what I want to tell you is that we will need a common, a shared sense of purpose, of ownership among all interested parties. It's a process which we need to do and to carry out together. As new director for financial markets in the Commission in charge of this file, I'm very committed, and I'll do my best in order to make sure that this will happen. But let me dare to count also on your precious support in order to achieve that objective, which I think it's, as I said, a common objective. Thank you very much for your attention.